time now to review the Monetary Policy Committee framework for setting interest rate in the country. The first 5 years of the Reserve Bank of India's MPC, which got a mandate to keep the inflation at 4%, is ending in March next year. The new arrangement agreed between the government and the RBI means a review of the inflation target and not the entire framework. But this new institutional framework for monetary policy does need a comprehensive review in the light of the past experience and also the emerging situation of a stagflation. The review should include the RBI's liquidity management and the use of various monetary tools like reverse repo, bank rate, CRR, exchange rate, which influences the liquidity in the system, thereby diluting the role of the MPC. In the last 5 years, the inflation, as measured by the CPI, did fell from 5% in 2016 when the MPC was constituted to below 2% in January 2019. But the average CPI or the retail inflation is over 6% in the current year. The inflation in the 2 consecutive quarters of January to March and April to June of 2020 has crossed the upper band of 6%. The July month has recorded a much higher CPI at 7%, though it is influenced by the supply side distortion created by the COVID lockdown. Clearly, for the first time in the last 5 years, the MPC is heading towards missing the inflation target of 6%, which is the upper tolerance level. The RBI will now have to do some explaining to the government for the breach of the target. There is now a need for a much comprehensive review of the MPC mandate than just giving a new inflation target. There are some experts who are questioning the benchmark itself, which is the CPI or the retail inflation. Globally, CPI is used as an inflation targeting benchmark, but the experts suggest that the share of food, almost half in the Indian CPI basket, is too high. There are suggestions for a mix of CPI and the WPI as the new anchor for the MPC to fix the interest rates. The recent liquidity management by the RBI has also seen the dilution in the MPC framework. Former RBI Governor Ujit Patel and the Deputy Governor Viral Acharya recently raised the issue of RBI pumping in surplus liquidity in the system, which dilutes the MPC framework. They both argued that if the MPC is the highest decision-making body for setting interest rate, the system should be in liquidity deficit or in small surplus, but the RBI has kept the liquidity system at a surplus mode. This has made the policy repo rate, which the MPC decides, ineffective, while the RBI's reverse repo rate set by the RBI has become the effective rate for absorbing large liquidity surpluses. This unilateral action by the RBI, which is outside the MPC, clearly dilutes the MPC framework. The MPC should have the mandate to use all the liquidity management tool to control the inflation. There is also an extreme view that the inflation target of 4% is too low for India. Post-COVID, the US Federal Reserve has indicated that it is all set to keep the interest rate at near zero level for a long period, even if the inflation rises. The objective is to support the growth and avoid an economic recession. Back home, the MPC review of setting inflation target will have to take into account a stagflation or a recession kind of a scenario, as the GDP has already plunged into the negative territory. The inflationary pressure is likely to come from the changing global supply chain because of the hostile China and the US-China trade war. There is also a likelihood of government increasing the taxes because of likely fall in the revenues both on the personal and the GST side. The global liquidity and the domestic liquidity is also expected to bring some price pressures. Gold, oil, steel and other raw material prices are already moving up. Inflation is like a tax on the poor. A middle income country like India should not take its eyes off from inflation. COVID has already pushed millions of people below the poverty line. The factories are getting shut. There are huge job losses and income cuts. The debt levels of the country and the household is also increasing by the day. A comprehensive review of the MPC framework is a must to keep a check on the inflation and not letting the economy falling into a recession or a stagflation situation.